Marty, thank you very much, and thank you for remembering the really remarkable history that our firm has had with your organization. It was 2014, I made a presentation at a family office conference and established a relationship with a family office that's been with us since then. It's a very important client of our firm. I'm going to walk through a primer on CLOs and what the opportunities are. We think the best opportunities are to invest in CLOs. Before I get there, I'm going to introduce myself a little bit. I'm a veteran, 27-year veteran of a firm whose name was smacked around a little bit, this firm. I was a partner at Goldman Sachs, actually a partner before the IPO and during the IPO. I ran the fixed income capital markets business at Goldman. And I had two careers at the firm. By the way, I got into Goldman Sachs because I did well at the Wharton School, which has also been mentioned a few times here. I joined Goldman in '85. I retired as a general partner in 2006. And in 2007, I was convinced by Lloyd Blankfein, who was the CEO at the time, to return to the firm, to build something that I think is quite unique at Goldman Sachs for a financial institution. I built the alumni network at Goldman Sachs, and Goldman has a great alumni network, and we institutionalized it in 2007. I stayed at the firm until 2013, and I stayed well past my personal expiration date, but sort of hung with the firm while it was going through a very difficult time during the financial crisis, and I retired a second time in June of 2013. In July of 2013, I became the chairman of what is now called Vibrant Capital Markets. I found Vibrant Capital because as I was leaving Goldman Sachs, I was looking for a better opportunity than what I was being offered at the Goldman Private Wealth platform. And Goldman, wisely coming out of the financial crisis, encouraged allocations to high yield and levered loans, which were deeply discounted during the financial crisis. And I saw CLO debt and equity to be providing superior risk and return. But Goldman didn't offer CLO debt and equity investing opportunities for individual investors. And when I was at the firm, I held roles that prohibited me from participating in that market. And so as I was retiring, I was looking for a manager that specialized in this area. And I found that manager and built a relationship with them in the last few months I had at the firm, and invested in the business and became a chairman of the firm in 2013, where I've been ever since. It's the only formal business activity I'm involved in. Otherwise, I spend much of my time, in fact, more of my time than I do at Vibrant, more of my time is spent in the nonprofit space. And I think there may be a bio for me on the site somewhere, Marty, but I'm involved in APAC, the American Israel Political Public Affairs Committee. I chair the National Museum of American Jewish History. I'm involved in the National Endowment, the National Trust for Humanities in Washington, and a number of other things. And so I spend most of my time in the nonprofit world. I should say I spend most of my time as a husband and father, and I'm also in the nonprofit world. So let's learn a little bit about CLOs. CLOs, during the financial crisis, CLOs became a four-letter word, but it is a very simple structure. It is basically a special purpose company that looks a lot like a bank. On the asset side is a large portfolio of diversified loans, And on the liability side is a debt capital structure that takes up about 90% of the capital structure, and about 10% of the capital structure is equity. So very much like a bank. The loan portfolios are diversified across industry and investor. That is by indenture. The indenture requires this diversification. And the rating agencies also drive the diversification. The more diversification, the lower the risk, the greater the AAA tranche of the deal, which is the lowest form of the lowest cost of capital in the CLO. On the slide you have here is the typical cost in the current market for CLOs. AAA debt, very low risk, floating rate at LIBOR plus 220 or SOFR plus 220, which is an index that's being used in the market. So right now LIBOR is about 450. So AAA CLO debt is offering floating rate returns of about almost 7%, right? That is very low risk, very low interest rate risk because it's floating rate, extremely low credit risk. And the risk that you have is some liquidity risk and some, I'll say, pricing risk as spreads in the market can widen and tighten. The part of the structure, this capital structure I like best is in the double B sector, where spreads now are over 900. That's 9 points over LIBOR, right? So LIBOR at 4.5, 950 plus 4.5. I think that's about 14%, and that's an average kind of spread. So there are some double B bonds that are at 13.5, 14, and some that are closer to 15. Again, floating rate and double B rated, and this is significantly higher than where levered loans are yielding, significantly higher than where high yield is. And the reason for this is the complexity of the instrument. You need pretty good technology and tools in order to manage these investments, in order to understand these investments. And the investments also are less liquid than high yield bonds, and less liquid than broadly syndicated levered loans. And because of that liquidity and because of the technology barrier, these trade at what I consider to be extra market yields, extraordinary yields. This chart is a chart of the default rates. Now, default rates are critical in understanding the values and credits. Defaults have been quite low. I think they're under 1% now, and these are defaults in the sort of levered finance space. There's an expectation that defaults are going to increase. There's an expectation of recession, and the expectation is defaults may inch up to about 4% in the coming year. And that's an important characteristic to the potential returns in CLOs. See the CLO structure, and we'll see this in a slide in the coming presentation. The CLO structure is actually insulates most of the debt tranches to even extraordinary default scenarios. Recovery, Marty.
Can you go back to that last slide?
I think
you have the CLO default rate right there. Yeah. So even when
loan default rates,
right, even when the loan defaults, those are typically restructured. There's not like 100% default. It's a restructuring that occurs to the loan. Is that correct? Is it
loans do get restructured.
Okay.
But these are actual default rates, and,
okay.
And in restructured loans, there's often a hit to the lender of some kind, right?
Okay, got it. Okay.
Yeah. And CLOs are direct investors in loans, right? And so if there's a loss in the loan, the loss actually is absorbed by the equity tranche initially of a CLO. Levered loans in the CLOs are almost all first lien, and the recovery rates when there is a default have averaged about 70%. Those recovery rates are expected to be a little bit lower in the next significant default wave. And we've seen here, there's a trend here where you can see some of the recovery rates have been lower in recent years. And we expect lower recovery rates. And there's a number of reasons for that, but we won't go into it at this time. The current CLO market has grown quite quickly, but it's grown along with other credit markets. It's grown with the levered loan market and the private debt market. And these markets have grown well over 10 times in the past 20 years. The CLO issuance market also remains quite strong and healthy. Issuance has been over 100 million and is expected to be over 100 million. Total CLO debt outstanding or CLOs outstanding is over 900 billion now. It's approaching $1 trillion market. CLO debt is all floating rate. The loans that are purchased inside of CLOs are all floating rate. And as we've heard several times this morning, interest rates have been going up. Loan prices, the broadly syndicated loan market at its inception was called the par loan market. It's called the par loan market because the loans are expected to be originated close to par, redeemed at par, and trade close to par. And this graph shows that they do many times trade close to par, but they often are trading well below par. What we see in this slide is a comparison, and I mentioned what I consider the extraordinary returns that are available in CLO debt. You see high yield bonds yielding around 9%, broadly syndicated loans on average yielding close to 10%, investment grade BBB CLO debt trading pretty close to where levered loans are trading, and BB CLO debt producing 14% plus yields. And we are in a period of time, and this graph doesn't show it clearly, but we're in sort of the top decile of spread levels for mezzanine CLO debt, the top decile. So relative to other credit markets, this is one of the best times to be investing in CLO debt. So a little summary here. Investing in fixed income, one needs to be concerned about credit risk and interest rate risk. I think relative to other instruments in the levered loan market, we think CLOs have superior credit protection. CLO debt has superior credit protection. They are floating rate, and so relative to high yield bonds, they have superior interest rate protection. CLOs pay income quarterly. We had a significant number of downgrades in the levered loan market because of the COVID crisis, but there were no defaults on CLO debt tranches. In fact, one of the interesting aspects of CLO debt during the great financial crisis, while the prices dropped dramatically, the market was, I think, the one major securitization market that didn't have government intervention, and the market restored to health very naturally without government support. And there was also minimal defaults coming from the great financial crisis. There have been 3 BB defaults in, I guess, what we call the 2.0 era, the CLO era since the financial crisis. In those 3 particular default scenarios, the returns to the debt holder was actually positive. We often think of a default as being a total wipeout. The investors got their money back. They didn't get a great return. It may have been a low single-digit return, but they didn't get completely wiped out. And this is a chart that sort of shows the extraordinary default scenarios that are going to be necessary to create losses from an investment in CLOs. And what we are combining here is cumulative default rates with recovery rates. What you see is that to invade the principle of a double B security, you need to have almost half the portfolio default. And that's a difficult, an unusual circumstance, because the portfolio, again, is diversified, about 150 credits in each portfolio, about 25 to 30 industries. So you need a real washout in the economy to damage the CLOs. This is another similar, I'll say, scenario analysis that talks about the default picture that would be necessary to damage the return on the CLOs. Again, high current income, CLOs are actively managed. Some of the recent deals are static, but most of the deals that we invest in are actively managed deals in which the manager who's managing the CLO portfolio can get out of credits they think are doing poorly. In CLO equity right now is being priced at a 30+% cash on cash return. Right? So CLO equity is the highest octane, highest potential return in the CLO capital structure. It's also, for that same reason, the highest risk. It produces significant income, almost all of it current income. So it's ideal for investors that have, let's say, charitable foundations or pension funds. Or if you're investing in a low tax rate jurisdiction. Otherwise, the income is subject to very high, for U.S. investors, very high personal income tax, and often produces capital losses at the end. So for many investors, it's the reverse of what you're looking for from a tax perspective. Our firm has a number of different vehicles that you can invest in if you're interested in CLO debt or CLO equity. We have open-ended hedge funds. We're developing a closed-end fund for CLO equity because we think the return environment for that is quite extraordinary. Again, and I should mention, I have a significant amount of my own fixed income allocation into this sector, as well as my investment firm. And I'm happy to answer any questions if there's time. And thank you all for actually mostly staying awake for most of this. Next to Tim Draper, this has got to be the most exciting thing I've heard all day.
This is great stuff. Can you go even an earlier slide there on the performance in 2008? You said a little bit further back on the rated debt. You passed it, I think. Did you pass it? A little bit further up. I guess go. I'm not sure I can find the slide. But anyway, you were talking about you guys only invest in the top 10% of top decile of CLOs. Is that what you said?
No.
Okay.
The spread environment.
Okay.
Is the spreads have widened out to an extent that this is the top decile of the spread history for CLO debt.
Got it.
So when you're buying double Bs at 9 points over LIBOR, right? That's only happened 1 out of 10 times in the past, 20 years.
So the first speakers that we had, the economists who were kind of forecasting, and then the fund manager selection group, alternative alpha, they had talked about how fixed income was making a comeback. They expect interest rates to continue going up. Do you think CLOs would ride that same wave of fixed incomes going up?
So CLOs and all credit products or hybrid products, right? They have an interest rate component, and there is I'll say an equity-like component. So equity market volatility, equity market weakness impacts the same risk premium that goes into pricing equity markets also affects credit markets.
Okay.
We think that the credit markets are, I'll say, have priced in a riskier environment than equity markets have priced in currently, and we think the credit markets are going to produce excellent returns. Excellent returns outright, and excellent returns relative to other markets.
Right, and you had discussed in the past that there's an advantageous tranche for the family offices to be involved in, or?
Well, listen, the family offices that that work with us, they're often multi-generational family offices, and the family members need income, right? They're investing in lots of things. They often have a barbell-like strategy where they're investing in higher risk type opportunities and venture type opportunities, but the family members need to eat, right? And so this is an excellent income product, particularly as a core portion of a portfolio. And so one of the families I'm thinking about, the matriarch of the family has a significant amount of her portfolio allocated to mezzanine CLO debt, and so gets a significant amount of income each year from this. So, if you have a $50 million allocation to BB CLO debt, you can expect a $7 million, I think that's right, $7 million of income, right? So a lot of people can live well on $7 million of income.
And you can put that
Some people,
you put it into like
no one in this.
you put it into trusts and things like that as well, or
I'm
thinking about multi-generational.
This could be, some of this is in trusts, some of this is in, individual allocations. It's hard to distinguish the individual from the trust in many of these situations. Yeah.
You mentioned that they're not liquid. They're not liquid investments in the sense of exit. So how does that work? Is there lockup periods or?
So I want to make sure I'm clear about this. Each of the tranches in CLOs, the equity all the way up to the AAA, trade every day, right? There's just a fewer number of investors who are sophisticated enough to trade in them, and it requires tools and risk appetite. So the turnover in our portfolio is actually pretty significant because we're constantly reevaluating and trading these. They just are not as liquid as, let me take a step back. A $500 million CLO will have about a $20 to $25 million BB tranche, all right? That $25 million security is unique and different from every other BB tranche in the CLO market because each portfolio is different and the structures are different. So if you own 10 of that $20 to $25 million tranche, it is less liquid than owning $10 million of a $500 million high yield bond that is broadly distributed and many people are trading. And so that's why it's less liquid, not illiquid. Okay.
When you're looking at these investments that you're making in the debt space, are you diversifying across industries?
Within the CLO,
Yes.
There's typically 25 to 30 industries that are represented in the CLO, and 150 to 200 different companies. And there's limitations as to how large a specific company can be with any credit within the CLO. But most of the investments are about 75 basis points to 1.5% of the portfolio. So it's diversified in name and diversified across industry.
Because some industries are obviously going to do better than others. So it would be to your advantage to figure out which industries you think will do well and to actually skew the portfolio into the.
Exactly right. The CLOs, we manage CLOs ourselves as well.
Yeah.
We avoided the energy crisis in 2014-15. We had almost no energy investments. There were some managers that were heavily invested in energy because it offered high yields, those loans, relatively high yields. And those were the CLOs that got into the most trouble. Retail also had its pockets of stress and as well.
We have two more questions. Hopefully they'll be brief.
Oh, I love these questions.
An excellent presentation on CLOs in general. My compliments, well done. And we've been an investor in CLOs for some time. One thing I'd love to hear a little more about is what separates your firm, not just the category of CLOs. What's the special sauce that you all bring, having been an investor, for example, in our case, among other places, Palmer Square, what sets your firm apart?
So that's an excellent firm. It's one of the few unique firms that are actually very specialized in this area. We have great respect for them. Listen, a founder of our firm grew up with the CLO business. He's been investing in CLOs for over 20 years. We have the firm itself has a very long track record investing in CLOs. And I think one of the things I'm most proud of, the reason I was most impressed by them, is they're all a bunch of math and physics people. Those of us who had careers in Wall Street and finance, the folks involved in the securitization businesses tended to major in math and physics and things like that. And that's true about our firm as well. They built all their own analytic tools. There's no off-the-shelf analytic products. They built it all themselves. 40% of the firm's headcount is in technology. So they're very focused on risk management, on developing unique tools for analyzing and managing not just the security itself, but the portfolio of these complex securities. So I'm very proud of that aspect of it. They're a little geeky, and I like that aspect about them. I'm not going to say Palmer Square doesn't have those attributes either, but that's I think one of our special qualities. So thank you.
Last question.
Hi, can you just talk briefly about the terms of the fund itself and whether the fund will also be investing in CLOs that you manage yourself?
So the fund there's a limitation, I think, on the equity fund to no more than 20% in our own name. We hate to buy in our own name because we don't earn CLO management fees when we own equity in our own name. So our fund is the best buyer, and we hate to sell to our own fund. But sometimes we think it's too cheap and we buy it. I don't think there's minuscule of our de minimis amount of our product in the debt funds. I actually don't think there's any, but it does have that capability.
And just what are going to be the general terms of the fund in terms of liquidity?
I'm going to make a mistake if I start quoting that to you, but there's a young man here who came with me, sort of my seeing eye dog, to get me through this. His name is Zach Radler. In fact, I'm using his computer, so it may look like I'm Zach Radler. And Zach will review it with you. But the debt fund actually offers monthly liquidity with 90-day notice, and I think the fees are 65 basis points or something like that. So back relatively reasonable.
Oh, fantastic, Phil. Great job. Thanks so much.
Thank you, Marty. Thank you for having me.